The housing market is facing an alarming downturn, with prices plummeting faster than they did in the 2008 crisis. Homeowners across the United States are growing increasingly concerned that rising mortgage rates will deter buyers and trigger a further decline in home prices. Experts admit that this reversal is one of the most unpredictable and unsettling since the 2008 crisis. Real estate analysts fear that prices might overshoot downwards after an expected double-digit decrease in home values early next year. Homeowners have already witnessed a staggering decline in equity, losing almost $1.5 trillion this year alone. It's safe to say they should brace themselves for a challenging 2023. In this video, we will reveal the unsettling truth about the housing market's current state. Before we dive in, we kindly ask you to subscribe to our channel and show your support by giving this video a thumbs up. The artificially low interest rates that prevailed after the health crisis have acted as a pinprick to the housing bubble constructed by the Federal Reserve. Data provided by the Dallas Fed reveals that home values increased by approximately 95% between the first quarter of 2013 and the second quarter of 2022. These historically low interest rates made mortgages more accessible, leading to significant growth, particularly between 2020 and 2022. For instance, in March 2020, the median price of an existing home stood at $287,000. By June 2022, it had soared to an estimated $413,800, marking an astonishing 47% increase in just 2 years. Eric Lund, the chief economist for the Conference Board, highlights that this surge surpassed even the rise in home prices during the last housing bubble. However, the reality is that American homeowners need to prepare for a gloomy 2023. From January 2020 to June 2022, U.S. home prices experienced a staggering 45% increase, primarily driven by low mortgage rates and the work-from-home trend. But now, mortgage purchase applications have plummeted by 41% compared to the previous year, sinking even lower than the peak of the 2008 financial crisis. This drop in demand signals the end of support for the current housing bubble, leading to an inevitable reversal. Enrique Martinique Garcia, an economist at the Dallas Fed, conducted research and warned that home prices could potentially fall by 20%. Such a decline would have profound effects on inflation, economic growth, and the long-term health of the economy. In the current environment, where housing demand shows signs of softening, monetary policy must tread carefully to avoid triggering a downward spiral in house prices. A significant housing sell-off could exacerbate an economic downturn, according to Martinez Garcia. Reasonable projections suggest that such a price adjustment could reduce real personal consumption by as much as 0.5 to 0.7 percentage points, negatively impacting overall demand. The Fed acknowledges that a 20% decline in property values could lead to an even worse crash. However, their projections are still modest compared to the overpriced nature of the current market. KPMG chief economist Swang asserts that once prices start to decline nationwide, a self-fulfilling momentum takes hold, as nobody wants to catch a falling knife. He believes that a conservative estimate of a 20% decline early next year is just the tip of the iceberg. According to Swang, prices are already highly inflated, and when the market turns, they tend to overshoot in the opposite direction. James Snidely, the president of ING Bank's International Department, highlights that the housing market's tight control before and during the pandemic necessitates a significant correction to restore sustainable levels. Despite recent price drops, the consensus among experts in the sector is that housing prices must decline at least twice as much as the Fed anticipates in order to return to their long-term trend. Charlie Katz-Nelson, CEO and Chief Investment Officer at Investment Management Associates, believes that housing prices need to drop by more than 40% for affordability to return to normal levels at current interest rates. However, Business Insider's data suggests that even a 40% drop in prices wouldn't be sufficient in some areas like Austin, Texas, where prices have surged by 93.5% in the last 2 years. Or Northport, Florida, where prices have risen by 83.4% since 2020. Glenn Kelman, CEO of Redfin, points out that housing markets have been teetering between the possibility of mild declines and considerably greater ones since 2007 to 2008. The housing slump is expected to continue putting downward pressure on home sales as housing affordability remains a significant concern. Thank you for watching. Please leave your comments below the video, and don't forget to subscribe to our channel.